and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Stephen Innes. He's a Chief Global Market Strategist at AxiCorp. Steve, great to have you back again this Wednesday.
Thanks for having me, Brian. Always good to see you.
Now, before we speak to you and get your insights, Steve, let's take a quick look at how markets are doing across the region. Now, it's pretty mixed. We've got the Nikkei that's in green territory. It's up 0.18% at 26,836.83. Shanghai Composite is 3,554.96, up 0.09%. Hang Seng is in red territory, down 0.07% at 26,548.78. ASX 200 is marginally up at 0.02% at 6,589.6, and the Kospi is up 1.32% at 2,668.92. Closer to home, Bursa Malaysia is trading at 1,598.47, and the Straits Times is trading at 2,803.21. It's marginally down 0.39%. Now, Steve, we've got a lot of good news around the world this week. The S&P 500 and the Nasdaq Composite both saw record closes overnight on Wall Street, on the back, obviously, of news of stimulus. Now, Australia's economy this morning then expanded 3.3% in the September quarter, smashing expectations for a 2.6% rise in a Reuters poll of economists. Then you couple that by Monday's good news that PMI data out of China basically exceeded expectations as well. Your view on this, Steve?
It's good. It's very good news, but I think the indices themselves don't really tell the full picture. There is a rotation going on. We all know that. The rotation is out of tech. That's the leadership on the board, and people are buying undervalued assets. So naturally, some of the heavier tech bourses are going to suffer a little bit. This is a problem because of the rotation. However, we have to look at this in general terms under the hood of the index, where single stock dispersion is starting to pick up quite significantly. And this is where most of the action has. So yeah, we always focus on the indices, but really it's the single stocks that are going to flourish, especially those undervalued pockets.
Can you give us some examples, Steve?
Yeah, the airline industries, for instance, they've been running at 30% depressed, and that's going to be a sector that the market's going to continue. They're coming from a deep, deep hole, and they're starting to see gradual buys into this. But we have to remember, at this time of year, it's not an optimal time year to start loading up on risk. The reason for that is there's a lot of investors and a lot of big funds who just natural propensity is to de-risk into December. They want to protect profits. So it's not the best time to have all this happen. But I'll tell you, that with the stimulus sirens going off this morning, I was very, very happy to see that some sort of bipartisan agreement was coming together, and this really makes the runway for 2021 look that much more attractive from a bipartisan Congress perspective. So I'm pretty impressed with what's happened over the last 24 hours.
Now, Steve, speaking of the 2021 runway, we need to talk about oil prices, because oil prices fell overnight because investors are awaiting direction from OPEC Plus. They postponed the meeting to Thursday. But what's your view on oil prices for the rest of the year? Is there an expectation on Thursday that there will be cuts or increases in production to show up prices?
Well, I think they're going to save face. I don't see them not putting the agreement through to defend oil prices. It's been their mantra for the last 2 years, and why would they all of a sudden break it now? I think there's a bit of a contentious issue here about compliance enforcement. I think the UAE is correct in their suggestions that they want stricter compliance. They want those laggards to make up what they haven't made up, and that's a problem. And that's where the fissure is between Saudi and UAE. Those are great allies in the past, and I think they'll probably see cooler heads prevail, but I'm not expecting oil to go flying higher into year end. The reason for that is we're still dealing with the devastated demand consequences of COVID. That's going to keep people shuttered through Christmas light, and driving's not going to happen. Look, at air travel is just starting to pick up internally within countries. It's certainly not going to pick up externally. So I don't see a big bounce in jet fuel. I think road demand petrol will continue to lag, at least until we get into the new year, where the vaccines start to work their way through the economy.
Steve, there's the other side of the coin, which is the overly, what I would consider, in my humble opinion, really an overly bullish outlook. Goldman Sachs says that this time next year, they're predicting $65 oil. Now,
Yeah.
where is that coming from?
Yeah, no, that's higher than mine. I'm looking at 60, so I'm not that far off. Look, we're coming from such a deep hole on the demand sector, where it's expected that the vaccines are going to re-engage the travel sector. That's the optimistic view we're having right now. So, if we gauge oil prices based on mobility from mobility from point A to point B, well, things are going to pick up. You're going to see cruise ships going to St. Mark's Square. You're going to see airliners landing in KLCI. You're going to see travel opening up in Thailand. All this is going to be quite positive. It's going to reflect through into the underlying industry. It's going to reflect through into the bottom line oil prices. I think this is where the optimism is getting built in. However, what we have to be very, very concerned is that we're having these historically massive cuts that have production cuts that have been taken on by OPEC. So they're going to have to roll those off. When will that happen? My target is those will start to roll off when we get to $60 per barrel. That's why I'm setting my target at 60.
And Steve, then the other equation, the end of the equation is also at $60. The shale boys are in the red and they will start pumping. So from a production wise, that's another huge lot of production that could come on stream into the market.
Well, that's true, but the counter argument there is that the shale oil investment remains extremely depressed because it's getting supplanted by ESG investment. Not only that, but there's a reluctance for banks to lend to the sector right now because it's sort of being viewed as a bad sector with the market moving to green. For example, Bank of Montreal in Canada has a huge loan portfolio into basically Houston. So it's $7 billion in U.S. assets, comprised mostly of the oil sector. They're pulling out. They're just closing shop. They're going to call in all those loans or sell those loans off. So that's sort of the domino effect that's starting to happen right now.
Wow.
I think what it's telling me right now, as far as oil's going, is that we're moving away from fossil fuel energy to green energy.
Okay, and moving on to the FX side of the equation, the dollar fell yesterday to its lowest in more than 2.5 years. Now, obviously, investor appetite for risk increased because of the stimulus news and also, of course, the overall global recovery story. But what's your view on the US dollar against currencies in ASEAN?
Well, I think it's very, very good because a lot of the Asian currencies led by the linchpin, the offshore yuan, have an absolutely huge yield advantage. And also they're seeing lots of inflows into the stock market. So both a carry perspective and both inflow into equity market perspective, I think it's going to do quite well. I expect the yuan to trade down towards 640 in Q1. And as far as other Asian currencies, well, they're just going to ride that coattail. There's a little bit of a hiccup and some idiosyncratic issues, like for instance, the ringgit is getting held up a little bit because of oil prices. We know there's a little bit of political diffusion going on between the central banks and the governments in Indonesia, but all this stuff is going to get ironed out quite readily. Looking at the way that the U.S. yield curve is working right now, sure, yields are going up, but they're getting pushed up by inflation break-evens. Inflation break-evens going higher is actually negative for the U.S. dollar, and if this trend continues, I expect the U.S. dollar to continue to weakening, but it's not going to weaken forever. It'll weaken like it always does for about the first 8 weeks into the new year, and then things will change. And that's what we have to remember. Things don't go up in a straight line in this market. There's always something that pops up that'll ultimately change the narrative.
On that, thank you very much for your time and insight, Steve. We've been speaking to Stephen Innes, Chief Global Market Strategist at Axie Corp on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations. This video will also be on our Facebook and LinkedIn sites. Please subscribe.